Hi, David. Thanks very much for making the journey from New York to be here today. Really appreciate it.
Thanks for having me.
My pleasure. You run the leading developer renewables IPP in the US market, which I feel very secure in. Would love to just start by hearing your personal story, running into the story of DESRI and its evolution over the last decade or more.
Well, thanks so much. I joined D.E. Shaw about 20 years ago, and when I came, it was to help build out the private equity business. Private equity was the discipline that I grew up in, and for the first 4 years, we invested about $1 billion, half in renewables and half in non-renewables. And very similar to a role someone would have on your investment team today. And then the global financial crisis happened, and our portfolio persevered and came out the other side pretty strong, but capital was very limited, especially at a hedge fund. And me and my partner started DESRI. And our idea was pretty simple. Capital was in short supply. We had a lot of knowledge about renewables, owning an onshore wind business called First Wind, an offshore wind business called Deepwater Wind. And there was a dearth of capital that could provide long-term and own an attractive, what we thought is rate of return on an infrastructure asset. So in 2011, we cobbled together $20 million of equity, and we bought a wind farm in Idaho. That went pretty well. We then bought a 4-megawatt farm in Pennsylvania, at the time the largest project in Pennsylvania. We bought a 4-megawatt farm in solar in Indiana, again, the largest project. And we started to learn about how do you operate and use some of the disciplines that we had, which was to finance these and own these and see how these operate. And these were really good financial investments. And we raised around $200 million. And then the market started to turn. Things had calmed down after the global financial crisis. And there started to become a desire for people to own long-term contracted assets, which to us feel a lot like a bond. And there became a lot of capital moving to that side of the world. And we had a lot of expertise in the development side. And so we started to see a need by developers to help them make their projects happen. Often a small development team had the ability to get the permit, maybe get land, get a power contract, but didn't have $300 million to build the project. And so we would come in a little earlier and help make that project a success. We did that a few different times and started to build a traditional IPP. All of this was always done with the GP capital, meaning we did not have access to the traditional hedge funds. And so therefore, we always had to be smart on capital, use the velocity of our capital in order to make these investments. And over time, we started to see as the market started to change and we built more and more skills, that there was a real opportunity to grow into different markets. We started to build our own development team. Well, fast forward. Today, we've got a business with a little over 7 gigawatts operating in the United States. We're about 80% PV solar, a little over 10% storage, and a little less than 10% in wind. We operate in about 25 different states.
Should we get your map slide up?
Sure. And as you'll see, we're not heavily concentrated in any one given market. We've got a lot which started in the West Coast, in California, in Arizona, in New Mexico, where the resource is very strong. But one of the things that's really interesting in the renewable business, and especially in solar today, is it's going across the United States. In about 2017, we started to go to the middle of the United States, states like Michigan and Indiana, and we've even got some stuff in the Northeast. So we've built a diversified portfolio using the same discipline, the same underwriting that we did when we started to build out a traditional IPP that we had Macquarie invest in September, or signed in September of 2024 and ultimately close earlier this year.
It's a fantastic story, and believe me, there are not too many IPPs out there in the renewable space with a footprint like that. One of the things that we've really noticed about you, and we've known each other for 10 years, is the great nimbleness, also discipline and pragmatism that has characterised your approach to the market. To some extent, no doubt born of that history and the pedigree that you have. Can you talk about how important that's been in driving you through the ups and downs of the market, and maybe how important you see that as in today's market and the years ahead?
Sure. So we started this business in late 2011, and Macquarie's investment was the first holding company investment we had raised. And in order to grow this business over that decade plus, we had to use a lot of financial discipline. We had to make sure we always were underwriting well, and we had to be very efficient with our capital. Many of our much larger competitors had the luxury of building things on balance sheet and calling, as I used to joke, call dad and they give them a loan. We didn't have that luxury. But that discipline has played to us very well in what has certainly been a complex environment over time. And so the same financial discipline we started with, which is we've got to underwrite every project. We are very focused on the duration of the contract. While we've been doing this for north of 10 years, our average power purchase agreement, so the average length of our contract, is 20 plus years. Every project gets financed on a standalone, non-recourse basis so that we don't take shortcuts. We don't have an ability to have one big mistake. Each project's got to stand alone and being done well. As the market has changed, we've had to evolve to where the opportunities are, where the needs for capital are, and therefore use our portfolio in that regard. But the same skills, the same underwriting, the same background of talent that we're looking for is across the whole team today.
We certainly have a view that renewables development is no longer a secret. There are plenty of people out there having a go at it. And you see that in many markets around the world, including the US. We don't know how many of those players are going to really make a success of it, though. And our feeling is that there's quite a high threshold of sophistication and resources to make yourself into a durable survivor and a success in the market. Is that how you see it? Do you think there are going to be winners and losers, survivors and others?
Yeah, so let me just compare and contrast today versus a decade ago if you want to build a PV solar plant. The first large 70 megawatt solar farm we built, we had 5 people on our team. The amount of development capital you needed to develop that project was less than $1 million. You hired a construction company or an EPC. They bought your modules. They bought your trackers, they built you a project, and you got a bow at the end. Today, none of that is true. On a recent project, we had north of $100 million in it before we started construction. We have a design team, we have a procurement team, we're buying the modules, we're buying the trackers, we're buying the inverters, we're doing the financing. And all of those skills are needed as the market's gotten more competitive. Now, that has mostly been an asset for us because a lot of our competitors either went in 2 extremes. They were a very small niche team, and that niche team could be very good in a locale. So they're excellent in southern New Mexico and know all the landowners and the permits, but they don't have the resources on a global basis to do procurement, to know what's going on in the supply chain, to deal with the complexity of tariffs or some of the new provisions in the Inflation Reduction Act. How do you capture domestic content? But you still got to be agile enough so that you're using all of these changing tools to be successful. So my view, Mark, is that the best players actually are winning and taking share, not just in terms of megawatt, but profitable megawatts, as the industry is growing and maturing, because the best players are using all of those different skills and taking margin or protection in each of those areas in order to make the overall project economic. And the players who don't have those skills are ultimately going away.
And embedded in our conversation so far is a recognition that you develop your way towards this big operating base that you have now. But I know that was a journey in itself, getting from maybe a financial investor's view, certainly our history as well, a decade ago, that it was nice to come in the last 6 months before construction started,
Yes.
thinking that you were there on the ground floor when actually some sponsor developer had been at work on it for 4 years up till that point. You've been on that journey to talk about the rationale for that and the management of that.
So in the early years, we would come in somewhere close to the start of construction. We would raise financing, and we'd build an asset with a turnkey agreement and own a bond. That's a pretty good business. If you price that well, you've got a great asset. And what started to happen is that market got competed away. Players continued to go in there. There was a boom of the yieldcos and public companies wanting to own those bonds. And what we wanted, in order to earn a good, attractive return, we needed to go a little earlier and find ways to go and create that opportunity. And if you can create the opportunity, you can make it look the dynamic that you wanted. So often we would get into a project and want to buy it, and everything was great except maybe their power contract was 12 years, and that wasn't something we wanted. And so we needed to create the skills to shape those type of things, which is we started to organically build a development business. Today, we own a development company. We have multiple joint ventures with developers that create organic opportunities for us to own good assets. So today, if we build 10 projects, if we're successful this year, we'll build close to 3 gigawatts. Some of them are through our organic development team. We had to build that from scratch. Some of them are with joint venture partners where they bring real local expertise. We've got 6 people in Michigan every day working with landowners, working to permit. We're providing the capital, and ultimately we'll be the owner of the asset. And then there's always a little bit of M&A, often in a form of a challenged project, a little bit of distress. We had to build those different skills. When we started, we were a couple of people, mostly finance people. Today, we're north of 250 people. We've got about half of our organization in Hyderabad, India, doing many things complementing our core US business. So accounting is happening there, asset management's happening there, design's happening there, and each one of those steps across the last 10, 12 years, we've built to support the growth in that US market.
I'm delighted that you have used the expression bond a couple of times to describe, because that's sort of my history and where I come from in terms of participation in this market as well. Single asset securitization, we used to call it, turning a road into a bond or whatever. It's a long way from underwriting a bond to run a portfolio of development risk. How do you make that an intelligible, manageable risk proposition that works with the kind of risk mandate that we have and can be relied upon to deliver the ratio of a success that we need, and the ratio of bonds, the output of bonds, as you've called it, coming out the other end of the machine?
Okay. There are some disciplines we implemented from day one that still apply today that we think are really good protections as a risk management tool. First off, we never built this business for AUM. We never built this to get large. We built this with our own money to make good financial investments. And 1 led to 2, which led to 10, which today we've built probably north of 70 projects. First off, every project, and sometimes that'll be adjacent projects, is built and financed on a standalone non-recourse basis. And so there's more labor that goes in up front, that's for sure. But when something like COVID happens, or in 2022 when you couldn't get panels from China, those were certainly painful moments in our business, but they would only affect a standalone asset or a few standalone assets. So our first part of risk management is if you went and looked at every one of our projects, they are standalone non-recourse. And so that's just a preventative tool to protect against any one thing propagating across the whole portfolio. Second, you'll see we've built a diversified portfolio. We're in 25 different states. We've got different offtakes. We've got different resource regions. We got different equipment. So all of those things done at the asset level are to ensure, A, we've got a good diversified portfolio. Now, the second part of this is once you own these, they are bonds, but they're bonds that have inverters break and things go wrong. You've had to make real investment in the team, in the quality of data and information in order so that you can fix those problems, solve those problems, and actively manage that portfolio. One of the tools we were able to use over the years to grow our business is we had to generate cash. In the operating portfolio, we were able to do north of 30 refinancings of those projects. We drove down the operating costs. So we would use those tools, they would use those assets to generate liquidity to reinvest, build a more diversified portfolio. So those are all things we've done to build what we think is a robust operating business to go along with our new generation business, which every year is trying to build new renewable projects across the US.
Makes sense. So we've talked about the inherent challenges of development and building out a portfolio and managing its operations. Let's talk about gratuitous challenges that may have just sprung up in the last few months. Put that in context for us. How, here you are totally immersed in an activity that seems to be not supported by the administration. How much threat and disruption is that really for you and your business?
Yeah, so certainly the current administration is a change, but let me just give some broad context. In the last 20 years, there's been Democrats in office, there's been Republicans in office. President Trump was the president 2 cycles ago, and we have seen no correlation to the success or failures of our business to any one administration. I can point you to some really great years when Trump was in office, and I can point you to some really bad years when President Biden was in office. So when we look back over the last 20 years, we do not see any correlation in our actual business. Now, I'm going to talk about the Inflation Reduction Act in a second, but if you take away the IRA, the federal government's got a lot of bluster and a lot of communication, but it doesn't really have a lot of direct impact on our day-to-day business. And that may sound surprising, but when you're building in Michigan, there are 3 groups of people you really need to focus on. The Public Service Commission. They're the party that approves any contract you do. The counterparties you're dealing with, which are often the local utilities, and the local permitting regime. If you want to get a permit in Michigan, it has nothing to do with who's the president. A local township or the county or the Public Service Commission, they're the ones who grant you your permit. And so I think a lot of people miss that the federal government only has influence on federal permitting land, which is mostly in the offshore wind business. So when I think about the success and failures we've had, they're always done on the local side. Now, the keys to be successful in Michigan are dramatically different than the keys to be successful in Virginia versus Texas. And so each of those markets is different and requires different expertise. Now, up until the Inflation Reduction Act, the only federal impact was on the tax credits. And the tax credits have been in place for 30 plus years, Democratic and Republican administration. We're a little more in tune to what's going on in the federal side today because of the Inflation Reduction Act in 2022, and mostly about change. We built a successful business before the IRA. I have no doubts the renewable industry will be very successful post an IRA. What is challenging in our world is change. There are people making real long-term investments, whether that's new power plants or new manufacturing facilities. And so that's something we're going to pay attention to. It's not a president item. It's more of a congressional point. Now, certainly the rhetoric is not great. This rhetoric is certainly about non-renewables. But I'll just give a couple of facts to give people some balance to that. In the last 2 years, 90% of new generation has been renewables in the United States. If you told me tomorrow you'll find me the best gas developer in the world, and they start today, I'll take the under in them having a project before 2030. There's a 0% chance they'll build a project before 2028. To be successful and build a power plant today is at least a 5-year process. In things like nuclear, it could be a 20-year process. But if you want to be successful today, you got to get your permit. You got to go through the interconnecting agencies. To just give an example of the challenges in the U.S. market and interconnect, we built a 300-megawatt facility in Ohio. Ohio is in a market called PJM, probably the area with the greatest power demand, data center demand. We operate that project, and we added an expansion to that facility. The expansion has very low upgrades because it's utilizing existing infrastructure. We filed for that application in 2019. PJM said, great news, we will be able to sync you to the grid in 2030. By the way, that's the exact same thing that we're doing in Missouri or in California and in many of the markets. So when you hear about the need for additional forms of power, I think there's a lot of good arguments that gas is going to be part of a solution that needs a lot more power. But that's not going to be the solution in 25 or 26. And when you start to think about 30 to 35, I think that'll be part of an overall power solution. And I think everybody ultimately knows that, whether they say that publicly or not.
The comments you made at the end there acknowledge implicitly that an answer in 2030 is nice, but actually there are pressing needs right now. Can we talk about where the demand is coming from and how that feeds into your outlook, and I guess get into the data world?
Okay.
And different, for example, xAI has got an installation in Memphis that's running on a field of gas-fired power plants. There's a sense of urgency. Are you seeing that?
For the last 20 years, power demand has mostly been flat in the United States. And so renewable generation's gone up, and coal-fired power plants have come down, and there's been some retirements of nuclear plants. It's basically been a replacement of existing generation. For the first time in my career, there's real power demand. I'm going to come back to AI because that's obviously one of the biggest, if not the biggest drivers. But there are a couple of other positive forces that are driving power demand. Electrification trends are happening. Names that you wouldn't think, like Exxon, are electrifying a lot of their fleet, causing real increase in demand. The domestic manufacturing is a real positive trend. You know, the Inflation Reduction Act did a lot of things, but for the first time on the public policy side, it gave incentive, instead it gave a carrot, not the stick, to come to the United States. One of our biggest module suppliers just finished building a manufacturing plant in Louisiana, and they need 500 megawatts of new load. That's happening across the United States. And then last, and the biggest, is the demand from the data centers for AI. There's real power need, though that power need is challenging to satisfy in the short term. Today, if you want to build a power plant and you got an interconnect, and you've got your permit, and you've got your power contract, to get a new transformer is 3 years. And so there are some real constraints that are preventing just adding power to the grid. So when we talk to a customer, We can offer them 2 types of solutions. We always start with something we've been working on for 3, 5, 7 years. We're signing contracts with many of these data centers, and that's well into the permitting phase. That's well into the interconnect phase, so that we can tell them, we'll start construction for you in 12 months, and your project will be online in 2 or 3 years. That's really what is happening. And so if we're successful executing our plan this year, every project we build this year has been planned at least 24 months in advance, other than 2 M&A projects, which the developer had been planning 5 years in advance.
Yeah. And we were talking before about a signal we see from the big data purchases that they don't just want the power, but they want to be able to demonstrate that their investment in data centers is triggering additional renewable power. They don't want to be coming to communities, to governments, and manifesting as a burden on the existing grid, forcing power prices up. We see that in a bunch of different markets around the world. Is that an experience you're having?
Look, the U.S. system is a little tricky, okay? Certainly, the big data center buyers are having an influence, and often a negative influence, on supply-demand and pushing the price up for the customer, okay? And the Public Service Commission, its job is to protect the ratepayer. And so when Meta comes to Indiana and says, I want 1 or 2 gigs more of power, that marginal need pushes the price of power up. And the Public Service Commission is very nervous about raising the price on their customer. There are many examples where probably the power buyer would be willing to pay a premium to not create that type of tension, but there are some tricky rules in the US that don't make that simple. Interstate transfer. So it's not that simple that you can just say, they'll buy your power, but the investment in distribution, the investment in infrastructure is socialized, and that's why it's a little bit of a challenge for the customer, for the new buyer, who may be a little more price inelastic, to go and just add generation, which would influence everyone else's price.
Okay, I see. Last question. We haven't been negotiating our recent investment in you for the entire 10 years that we've known you, but it was a laugh from Julius of DE Shaw in the front row there. But it did take quite a while, let's say 2 years, maybe 3 years. You were very patient with us. Why were you that patient? And do you regret it yet?
Okay. Let me, just to start off, I had been at DE Shaw for 20 years, and we had the luxury of not having to invest out of a fund, invest out of the GP, and therefore we're incredibly patient. We never needed to get liquidity, we didn't need an exit, and we had the ability to make good long-term decisions and not have to deal with the vagaries of a short-term thinking. And so as we saw the market change and consolidations happening and capital needs were going up, we wanted to find a partner that aligned with those incentives. That was goal number 1, 2, and 3. And so when we got serious about this, Julius, myself, my partner, we had a real conversation. We did not pursue any of the traditional private equity-oriented funds. We did not pursue anybody who we thought misaligned with us on timing and on strategic objectives. And your colleague, Will, and I have gone back north of a decade. We've done business with Macquarie before. We know them, and we thought your fund structure aligned with our goals, which is, how do we consistently grow net asset value over time? How do we make sure we're generating nice cash, but not taking risks that are inconsistent with what this asset class offers? And so, fortunately, we were in the position where we didn't need to do a deal. We wanted to set up the right structure and the right long-term incentive, and relationship with the team, the type of fund structure you had, and your familiarity with renewables, because we can go back only 3 months and see some changes in the market, and that's been a common theme over the last 20 years. The renewable business has been not linear at all, and having a partner who knows how to handle the ups and downs was critical. So all of those led to a partnership.
That's very good to hear. David, thank you so much for those comments and telling your story, which, to my mind, completely fulfills the expectations that we have, and we're looking forward to many years of partnership ahead.
Thank you. Thank you
Thanks
so
very
much.